Cynthia will unveil her newest indicator, Kase Private Label. This new mega indicator captures and condenses all the best features of Kase StatWare into our user-friendly systematic indicator. So without further ado, please join in welcoming Cynthia Kase for this very special Trade Like a Pro event. Take it away, Cynthia.
Well, greetings everyone. I just wanted to start off with some introductory comments and to I have to press OK here. Yes, some introductory comments and to give you a little bit of an overview of my approach before we get into the technical stuff. So we're going to talk about my StatWare secrets and my new, quote, secret software. And, oh, I'm not pressing the right button. Okay, so why did I develop the Kase indicators? And before I get started, I'd like to invite you all to submit your questions. And my colleague, who's also on with me, Dean Rogers, will let me know what your questions are so that I can answer them during the session. So feel free to send in questions. So I designed precision indicators for trading individual markets. And the reason for this is that when I got started as a trader, I was an oil trader. And so I didn't have the option to look at many different markets and pick a market that looked like a good trading market. I had to have an approach that worked in the market that I was trading, which was either gasoline or heating oil, jet fuel, crude oil, all the time. So I could not use a low probability portfolio approach. What I mean by that is that some systems work by taking trades based on a system, closing out those trades that are losing, and letting the trades that are profitable run. But if you think about it, if you toss 1,000 coins at once, you're going to come up pretty close to 50-50. But if you toss one coin in series, you might have a run of 10 or even 20 that come up tails, for example, if you're betting heads. So if you're trading an individual commodity or issue, you have to be much more precise. So I needed a discretionary but systematic methodology. And what I mean by that is that I wanted to use my brain power. I was a professional trader being paid to trade. And so if professional traders used black box or automated systems, there would be no need for that trader to be in the job. So most professional traders trade with a combination of a systematic methodology and also applying what's up here. And there's still a lot of things that computers cannot do. Okay. So one of the other things that I did was to emphasize exits. Most trading systems, when I first learned to trade technically, all the trading systems were really oriented, and when I say system, I don't mean black box systems, I mean approaches to trading, used an emphasis on entering. And that's because the stock market, the equity market, had always been focused on buy and hold strategies for their clients. But again, as an oil trader in the market every day, I had to get in and out and in and out. So I had to learn how to balance profits with losses, letting profits run and cutting losses, and I had to manage risk much more closely because I didn't have a basket of various different equities, for example, to use to diversify risk. Thus, I have an emphasis on exits and as well as some very precise momentum divergence and overbought, oversold techniques. So with that, I'm going to go ahead and turn off the camera, and we're going to get started backwards by talking about exits and then momentum and then entries. Okay, so it says my microphone is still on. So many of you are familiar with this old-fashioned way of exiting, break even from entry. And what break even from entry just means that if you lose money, you get out. If you make money, you stay in. The problem with that is that if you are I'm going to see if I get my pointer here. If you were short here, for example, and coming down like this, it would be very difficult just to stay short until you broke even. You'd have to give it all back, which you don't want to do. And this would be your break-even point if you were buying here. Another way to exit is a fixed value from entry. So here's your break-even, and then you'd allow a little room for the trade to go against you before it started to make money. Again, this is great for when you just get started with the trade, but when the trade is making money, you don't want it to come all the way back in order to get out. One of the most common types of stops is what we call a fixed value trailing stop, a fixed value trailing stop. And as most of you know, a trailing stop trails the market. And the big dilemma with using a fixed value stop is how wide the stop would be. Now, if any of you have heard me talk before, one of the things that I use as a guideline for a fixed value trailing stop is the spacing of the values on the y-axis. Nevertheless, it's just a guess. And I've also heard it taught that one should place stops based on what one can afford. The only problem with that is the market does not care what you can afford. So here on the left, we have a fixed value trailing stop, $3 on MMM and 3M, and you can see it's too narrow. And here on the right-hand side, we've doubled it, and it's too wide. So again, one of the big dilemmas with a fixed value trailing stop is trying to figure out what the magnitude of that stop should be. So when I faced this problem, throughout most of the 80s, crude oil had been very stable, and the range on the day for crude was about 50 cents, 45 to 50 cents, with a standard deviation maybe of 10 or 15 cents. It was very, very stable. But then, at the end of the 80s, into the early 90s, the Gulf crisis broke out. And instead of 50 cents a day, the range went up to $2 and sometimes $4 a day. And so I began to think about using the true range for my stops. And so what the true range is it's the high minus the low. And you can see here on the left, the low overlaps the previous day's close or previous bar's close. So the high to low range here is the most money one can win or lose in a given bar. Here, however, the previous close is below the low, so the maximum amount of money one can lose is the high minus previous close, or here, the previous close minus the low. So that's what the true range is. And a double true range, which I use often, is just basically the highest high over 3 bars versus the lowest low, or the close of the second bar back. So that's what the double true range is. When I first started to use the true range, I leveraged off of Wilder's parabolic stop and reverse, true range stop and reverse system, where he just multiplied the true range by a certain number, and if the particular level was hit, he would stop and reverse in the opposite direction. So I used a fixed multiple times the true range and came up with three levels of stops. One is a take profit stop, the second is a scale out stop, and the third is kind of an emergency stop that you would always have in place to make sure that if the market went against you very quickly, you could get out. So these kinds of stops hold pretty well during trends, but during choppy markets, they tend to be hit prematurely, because in choppy markets, one gets an increase in volatility, and this increase in volatility isn't properly reflected with a fixed multiple stop. The reason for that is that...
It's Dean.
Yes?
We've got a question from Manny.
Yep.
He's asking, does methodology work on E-mini futures for day trading on 4 range charts?
Yeah, I mean, it'll work on anything, but as I'm going to show, my recommendation is that you use stops that take into consideration not only the average true range, going back to this, the A here stands for average. So these stops use an average true range. What I'm going to recommend is, instead of using an average, we recommend an average plus a certain number of standard deviations of the true range. But so let me explain why one would want to use a standard deviation of true range. Here are 2 charts, 2 distributions, both of which have an average true range of 450. However, the one on the left has a standard deviation of 50. The one on the right has a standard deviation of 16.7. And so what that means is that at the 97.5% level, that is 47.5 above the mean, the value for the one on the left is 550, the value for the one on the right is 483. And so if you think about these distributions being bars, true range size of bars, you can see that if you're just multiplying an average, you're going to get a stop that's perhaps too small for the distribution on the left and too large for the distribution on the right. Further, actual distributions are skewed. So in real life, the bigger bars, the bars that are above the mean, can be much bigger, and bars that are below the mean are fairly standard. And when you think about it, there are a lot of people well over 6 feet tall, but on the downside, I'm talking about adult people. We don't see adult people that are 1 foot tall, and so you get this skew to the right in the sense that the size cannot be less than 0. So you're bounded by 0 on the downside, but you're not bounded by anything on the upside. So if you are putting a stop together that's going to consider the size of your bars, you have to account for right-hand skew. Before I discuss the dev stops, okay.
From Joanne M. She's asking, are you doing your own standard deviation calculation?
Well, Joanna, I'm not really sure what you mean by that. I use a standard mathematical calculation for standard deviation that would be in any textbook. So I'm really not sure what you mean by my own. In the code that we have put together in order to display the dev stops, there is a standard deviation calculation, but it's the standard deviation calculation that you'll find in any textbook, any Excel spreadsheet, etc. So I happen to show. So let me just explain that for the first levels, we have a warning line, which is just to kind of get ready. Your stop's been hit. We have a 1 standard deviation line, Dev 1. We have a 2 standard deviation line, but that's been corrected by 10% because the skew at the second standard deviation is right around 10%. And at the third level standard deviation, we have a 20% correction. I want to address the question that someone asked me before about could these stops be used for range bars? And the answer is yes. But what's the characteristic of range bars is that their standard deviation of the range bars, the true range of range bars, is much, much lower than time bars. And so we have special settings that we will give anybody who takes a trial or gets our materials for range bars that are somewhat larger. Okay, Dean, did you have a question? Did someone have a question?
Another question was if these could be used for day trading.
Yeah, I mean, it can be used for any sort of. Let me say this: if your bars are long enough for day trading, in other words, I wouldn't want to use it for a 2-second bar, but if your bars are long enough for you to trade, then these can be used for that. And we are going to set. Okay, so this is being recorded. It's going to be posted and all that good stuff. And another advantage of the Kase Dev stops is that they are more reactive and respond well and adapt very well, even in choppy markets. We saw a few slides ago that the fixed value trailing stop and the multiple of true range stop didn't work particularly well in choppy markets. And here's a situation where you've got a much more reactive stop system. All right. Okay, so Dean is screening the questions, so he'll only interrupt me if the question seems of particular import. All right, so this is a different look using the same math as the dev stops, and this is called dashes in our new system. Kase Private Label. This is the first time I've ever talked about this system in public. So the private label dev stops simplifies the stops into 2 levels instead of 4, and also plots the stops on both sides of the market. And so, for example, here there's kind of a little mini move down. So you've got stops both above the market and below the market. Here there's only stops below the market because there's no mini move down. However, if you look closely here, there's both a mini move down, but also the major trend is still up. So we give stops on both sides of the market where there's a major trend and little mini trends, because we have no way of knowing if one is trading the mini trend or the major trend. So this solves the problem of having a situation where you have taken a trade because of your particular strategy where the stop is on the opposite side of the market. Okay, so we've looked at stops, and people always ask me, I'll go back, what do you do with stops? Well, you use stops to exit, depending on your strategy. So, for example, here at the very beginning of the chart, as the market went up through your short stops, you might have exited your short. So that's how we use stops. Okay. So now we're adding momentum divergence to the stops. So I've got the RSI, the stochastic, and the MACD on the chart here with the stops and identified momentum divergence. So for those of you who aren't particularly familiar with momentum divergence, consists of a higher high in price or a lower low in price, in this case a higher high in price with a lower high in momentum. And this is a very strong exit signal because all 3 of these momentum divergent signals are divergent. And so you might, for example, when you get a confirmation here of the divergence, you might take 50%. In this case, you might take 80% of your profit because of the triple divergence. And then maybe as you hit stop 1, 2, and then 3 over here, you might scale out of the remaining 20%. Or if you're trading fewer contracts, let's say you're only trading 4 contracts or 4 shares of something, you'd get out of 1, 2, 3, and 4. So that's how you can combine momentum divergence with exits. Did I go in the wrong direction? Oh, here's just another one of dashes with the changing directions. I think I got my slides a little bit out of order here. So this is just another look at the dashes where the direction changes and the dashes show up on both sides, on above and below. So no matter where you are in this pattern, you no matter where you are in this pattern, you'll have a stop. Now, one of the issues with traditional indicators, and in my mind, the 3 major momentum indicators of the RSI, stochastic, and MACD, is they miss turns. And I have here, oops, missed the turn, because all 3 of these patterns are non-divergent. So here is a lower low in price, and then we're looking for a lower high in momentum, and we don't find it. We have a lower low, and a lower low, and a lower low. So, okay, lower low. So these are all non-divergent. The problem is that traditional indicators are unidirectional. Now, I'll be telling you in a couple minutes that Dean and I will be having some chat room sessions starting tomorrow morning at 10:30 Eastern and 7:30 Pacific to discuss the Kase system and any questions that you have. And so I'll be getting into the nitty-gritty of the mathematics for those of you who are interested in it sometime between tomorrow and May 16th, 10 days from now. So I'm not going to get too much into the math of why these indicators are unidirectional versus the Kase bidirectional at this point. But what I want to show you here is, if you look at how often indicators are followed by turns based on our stop 1, stop 3, you'll see that a given indicator is followed by a turn most of the time, 70% of the time, 72% of the time, 68% of the time. However, if you look at how often indicators precede turns, precede turns. So if you have a turn and you look back and you look to see whether an indicator caught the turn, you could see that indicators on average catch turns only about 50% of the time, maybe a little less. So traditional indicators, if you're trading a portfolio and you're searching for a momentum divergence, that's great. You'll probably find that 7 out of 10 times momentum divergence will be followed by a turn. Now, when I say turn, it doesn't mean a huge turn. It means a turn that's big enough to get stopped out. So if you have 1,000 different things to look at, you can look at whether or not you have a momentum divergence. But if, like I was, you're trading one thing or a small number of things, like the E-mini, for example, or maybe just currencies or something, you're not going to be able to page through 1,000 different charts looking for particular formation. You have to trade the chart you're on. And so what this is telling me is that 50% of the time, when I wish I would have gotten out, I didn't get out because I didn't get a signal. So the solution to this is my momentum indicators. I have 2. One's called the Kase peak oscillator. And again, I'm not going to get into the math here, but just to be brief, the Kase peak oscillator and its derivative, the Kase CD, use cycle length optimization, are based on the same volatility mathematics that are used for options math, and use random walk theory. And so they just happen to be much more accurate. So if you look at this chart, you can see at the top of the market here, the RSI is non-divergent. The reason that RSI is non-divergent is that at the peak here, it's higher than it was back here. And the stochastic at the peak here is higher than it was back here. The Kase peak oscillator at the peak is lower than it was back here. So it's divergent. And again, I'm not going to get into all the math as to why it's better. At this point, just want to show you an example of how it is better. Here's the Kase CD, which I always match up to the MACD. And you can see here that, the Kase CD is divergent, and the MACD is non-divergent. And somebody just asked a question. I just happened to notice that, do we still have institutional clients? Most of my practice is corporate and institutional clients. Most of my practice has always been corporate and institutional clients. That's why you don't hear from me all that often. Here also, you see this little K. Now this K is an oversold signal. And one of the things that any of you who have, used the MACD might be frustrated about is that the MACD does not have overbought and oversold signals. The MACD, because it's based on differences of moving averages, is subject to what particular units and numbers are on the y-axis, where the KCD is purely statistical, and so the cycle length optimization forces an overbought or oversold signal to be taking place on a single bar, and so forth. So in addition to the fact that the MAC is non-divergent, the MACD doesn't have anything here telling you you're going to get a little bit of a bounce here. And here's the same situation. The stochastic, of course, theoretically gives you overbought or oversold signals. But as you can see, the stochastic often will come up to the top of a market and just remain overbought, or go to the bottom of a market and remain oversold. Where the P here is the Kase peak oscillator, that for the P, and the Kase peak oscillator for the P, overbought and oversold signals. So again, the cycle length optimization, etc., pushes the peaks to be in one discrete bar and gives very clean overbought or oversold signals. Okay, I'm going to go a little faster here. Again, here's another example of the MACD and KCD, and the KCD again does not give or generate overbought or oversold signals. And the result is that Kase indicators are bidirectional, 75%, 70% or so. When they take place, there'll be a turn afterwards, but a full 80% of the time, there's a turn, there's been a signal. So they're reliable for giving a warning, at least reliable 80% of the time, for giving a warning that the market might turn. Okay, and this is I'm not going to take a lot of time with this, but here's another slide of how the indicators might be used with stops. Here you have overbought signals, market comes down through the stops, and then here you have a momentum divergence. Again, you've got a drop, and then down here, bullish divergence and an incline up. It's just a quick snapshot of what it looks like. Okay, so here's more about our live chat sessions, May 7th through 16, 10:30 Eastern, 7:30 Pacific. We'll discuss special features, math, patterns, plus your questions, and here's the link. Okay, so just very quickly, one of the things that I've tried to do is build in some additional functionality that I like to use. I always like to filter my chart with the longer time frame. But there's two problems with that, is that you might have to look at two charts. And then also, if you're trading, let's say, a 2-minute chart and you're screening it with a 10-minute filter, you have to wait 8 minutes, technically speaking, to get your signal. So what we do is we build in a rolling higher bar number window. So, for example, rather than having 3 bars, like 3 windows like this, 1 through 5, 6 through 10, 11 through 15, we would have 1 through 5, 2 through 6, 3 through 7, etc., 4 through 8, in order to speed up the filtering process. And again, we'll cover more of the math on this during our chat sessions, but here's a weekly stochastic. And here's a case permission stochastic, filtering a daily chart. And just very, very quickly, there's 1, 2, 3, 4 sets of whipsaws. And really, this is lots of whipsaws down here. That's totally avoided by the case permission stochastic. And then the filters, where you're looking for a short signal to take a short and a long signal, a long crossover to take a long, are 3, 2, 1, 1, and 2 bars earlier than just using a higher time frame filter. Okay, so one of the best systems for entries, now I've kind of worked my way up to entries, is that I would like to use lots of crossovers, and I'd like to filter it, and I'd like to look at swings, but I'd like to look at all this stuff. Yeah, the problem is it's just too much. Here I have RSI, stochastic RSI, MACD crossover, KCD crossover system with the case permission stochastic. And if you only look at the right-hand side of the chart, it looks pretty nice. I have a crossover, 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 crossover. They all stay long. I look at my pullbacks, and when I get an up bar after a pullback, I go long. However, if I was going to try to trade back here, I'd have an awful lot of crossovers to try to be dealing with and matching up and seeing if they're taking place at the same time, and trying to keep track of the status of the RSI, status of the stochastic, and all that stuff. It's just too much. So I have that all built in to my entry system. I call that Kase Easy Entry System. It tells you when you have a sell, tells you when you have a buy, and then it makes it clear whether or not it's a first or a second buy. We never take first buys. So on this side, we had, just to kind of remind you, we had all those circles over here. All that boiled down to 2 sell signals, neither of which were valid because they followed higher highs. Followed lower highs. But down here we have a first buy, we have a pullback, we have a second buy, boom, long. And you can see it's color-coded. And if you don't want to look at all these color coding on the bar, you can just turn it off. So that's the entry system. Okay, so now I'm going to get into the last few minutes here with some real trade examples. And I'm looking here at Apple, and all this is an overview of the chart. Just kind of want to, as we're trading, we want to kind of keep track of how many corrections we've had and how deep they are. So I'm kind of looking at this, and I see 1, 2, kind of shallow corrections, but now I'm up to 3. I always become more vigilant. And then turning to the downside, I have 1, and then maybe another little one, which might be, one of the second. It's the second one I'm seeing, but it's just a little teeny correction. Maybe of a subwave. So I like to do an overview like this and kind of be referring to it as I'm going through my charts. All right, so this is StatWare. Pretty straightforward. Here is an oversold signal, followed by, number 1 is my first long signal. Don't take that, I want to wait till my second long signal. All right, so my second long signal. And as I'm entering, I'm just going to put my stop at the previous low simply because my stops are above the market. They haven't flipped to the downside yet. So now they flip to the downside for a long trade. I'm going to put my stop at level 3 in the absence of any risk. And you can see confirmation, confirmation, confirmation of the long trade. Now I get one S up here, but it's a first S. We never take the first signal in this system. Oh, I skipped number 4. I just want to show you that there's no peak on number 4. If you look very closely, these little teeny red dots on the peaks. And here on this peak is no peak. And that's because we have a filtering system that filters out insignificant peaks. So that's one of the things that makes our indicators work better, is that they don't deal with these little insignificant peaks, which would have caused us to exit perhaps prematurely. In any case, the market still holds the first level stop. We get a reconfirmation on the long side. So I'm long, 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 long. Up here at the peak, number 6, I have a double exit signal. I've got an overbought signal with the green P, peak out, and I have a momentum divergence on the KCD. So that's a divergence and an overbought situation. Per our typical rules, we would exit 80%. You can always sculpt that to what you like, moderate it to what you like. But our normal rules would be take 80%. And at 7, the first level stop is hit. There's also a short. It's the first short, so I'm going to kind of grind my teeth there, wait for the second short. 8, I'm short, and the market holds stops, and we're short through the end of the chart. And if you'd like to see anything like E-mini or whatever, just tune into the chat room, and we'll pull up charts as you like. So now I'm going to move to Kase Private Label. It only has 3 simple signals. It's got diamonds for entries, it's got momentum arrows for momentum, and it's got dashes for stops. So 3 sets of symbols and with some color coding. So here's what that same chart looks like. Here's a yellow diamond. That's a warning. Green diamond, get long. Green, 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 all the way up. Here's my first, my second little correction. Here's my third correction. I might get a little bit more concerned. So I might look for, I might be looking for, I'm sorry, it's my I'm going to look at my notes here. My second correction. I might say, well, if I get a close below stop 1, I'll get out. But there's no close below stop 1. The stops hold. I get a reconfirmation at 4. Market goes up. Now this is my third correction. So I'm going to be much more picky about what I do here at the top of the market. So I may take profit on a portion of my trade, and if I had done that, here I go 1, 2, 3, 4, 5. I'm 5 bars. I'm 5 bars over with no profit. So we call that an inactivity exit. That's a certainly a discretionary exit that one can take. Hold on, I'm looking at my notes here. Okay, so by 6, you should be out of the remainder on inactivity. And then we could get short at 7. Brave of heart would get short at 7. And watch it hold the stops. Stops do not get hit. And that certainly looks like a corrective move. And then if you didn't, if you were short at 7, you'd stay short through 8, down into 9. And if you had not gotten short at 7, or panicked and gotten short and gotten out on the green, you'd reverse to short on 8. So either way, you could be short from 7 or from 8. And then we're short into the end of the chart, just like the apple that we looked at and StatWare was. And this works across everything. I'm a commodities person. You know, we do commodities every day, in and out. That's all. You know, all we really look at on a day-to-day basis is commodities. Okay, here's Chevron. Here are, I'm just counting my my corrections, just to give me a little bit of a map here. I'm looking at my corrections, and I've got one little teeny correction at the top. So then I've got the second correction, or that could be the first correction of the next set down. 1, I, or and then 3, or I. So at the bottom of the market, we have 3 of the whole thing and triple I of the second part of this thing. And then we have a smaller wave, 1, 2, 3, correction. Again, a pretty shallow small wave, 1, 2, 3, correction. So this would be the first correction in here, a second correction in there, just to kind of get an overview of what is going on. Now, I'll go to this example, and I'm going to grab my notes again here. Okay, so we have a first short signal that's ignored. 2 is the second short signal, so we take that. We're down here to an oversold situation, but if you look very closely, you see this K is gray. And the big deal about this K being gray is that the confirmation of this K was took place during a down bar. You can see this pink down bar. So that dampens this K. So we filter our overbought and oversold signals. We filter our divergence signals for whether or not the bars are closing up or closing down. So we have a shallow move up, watching the stops, never hits the stops. You get a confirmation with the S, down, down, down. You have a green P, along with the divergence, heavy exit signal. You're out of 80% of your trade. And you're kind of going along here, and then boom, you hit stop 1. You're out of the last 20% of your trade. Here is at 9. You've got your second long signal. You're long. Long, 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 long. No danger sign. Long, 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 long. But up here is a momentum divergence along with the first sell. So we're going to get out of 80% of our trade. And we exit the market here with either flat or only holding 20% long. So that's typically how that works. And here's the Kase Private Label, almost the same thing. The same but only different. Okay, so we have the first yellow diamond here, along with an arrow. We call that a pierced diamond. This is allowable here to take a short. If you didn't take it here, here's your short purple diamond. You're short. Short, 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 all the way down. There is a gray arrow pointing up, meaning that, or is that transparent arrow pointing up? If the arrow is transparent, means it's a soft signal, just like the gray K was before. So it's probably not too much of a big deal. You just have to watch it. You're watching it. You get a reconfirmation here, down, 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 down. And then here at 5, you have a double arrow. That means you have an overbought, an oversold signal, and you have a divergent signal pointing in the right direction. It's a pretty strong exit signal. It's followed by a yellow warning diamond. So if you were brave of heart, you could go short right there. Excuse me, long right there. And I'm going to ride this long all the way up. There's really no danger signs at all the way up. Here is your first danger sign. These numbers here, 8, 9, just showing you that the stops are holding. And here is a confirmation of a divergence, but it's in the wrong direction, so it's transparent. But it's followed by another pierced diamond take that seriously, probably out of 80% of your trade, and then as we come down, get ready to exit the other 20%. Now I am going to page through the rest of the charts. Don't want to take too much time with them. Now this is a kind of an elaborate example of EXOM Daily, and I will post the notes on these so that we can wrap up without taking too much time. The last slide about Kase Private Label I want to show you is here's your normal chart with your stops on either side. But as you can imagine, if you have all the stuff going on the chart, historically, if I want to show you what's going on historically, I have to show you all the way back here. We have a little button where you can turn it off except for the very right-hand side of the chart. So you don't need it back in the past. You just need it for the bars that you're trading. So you can flip a switch and just show the chart, show the stops for the last 10 bars to clean up your chart. The functionality also includes a risk indicator. The two little numbers here, like 304 and 503, will simply show you what the risk is associated with the first stop and the second stop. And if you know what your risk per unit is, then you can figure out how much risk you're taking overall by multiplying it by your, how many shares or how many units of a particular commodity you're trading. This is an invention of mine. It's called a risk ratio, and it's a ratio of the standard deviation to the average true range. The lower this number is, the better the trading market is. So if this number is below 0.5, like if it's 0.37, 0.43 like this one is, that means you have a pretty good trading market. If it's like 0.7, it means it's really choppy, really hard to trade. So this is a nice index, so to speak, to check out how difficult, at least going back retrospectively, a particular chart has been to trade. Now, again, I'm not going to spend a lot of time on this, but I've got risk of ruin calculations derives from game theory. So if you know how much you want, if you knowing any of the two, if you know the amount that you're willing to lose in a given trade, if you know the total amount of capital you're willing to lose, and if you know what percent chance you're willing to take of losing all your capital, then you can figure out what risks you can take. And again, I'm going to go through this in much more detail in our chat room, but if you have a portfolio size here, and I can't see, I think there's 6 zeros there, and so $100,000, and you win 55% of the time. Your win to loss ratio is 1.5. This is just some technical stuff, but where it shows up on the chart on the page, for a 0.25% chance, a 0.5% chance, 1% chance, and 5% chance of losing $100,000 with this kind of a track record, based on the Kase's stops. I use the wide stop, the widest stop for these calculations. This tells you what your risk is per trade and how many units per trade you can take. So, for example, if you're willing to take a 5% chance of losing everything, you can trade a little over 20 grand, 300 and some units. Whereas if you only want a 0.25% chance of losing everything, then it's 10,000. So I have 3 slides here. This is solving for risk per trade and units per trade. This is solving for what your percent risk of ruin is, what your percent chance of losing everything is, and your units per trade. And this one is the same thing, what your chances of losing everything and what your risk per trade is. So this indicator is included as a bonus over and above the products, Kase StatWare, Kase Private Label, which we're offering at more than 25% off if you purchase a lease of either Kase StatWare or Kase Private Label by the 16th. So let's see what else I have here. Best value, promotional price, available until the 16th. So here this is. You'll get to keep the risk of ruin indicator after the initial lease, regardless as to whether or not you renew it. So if you sign up for the 13-month offer, whatever happens, at month 14, you'll still have the risk of ruin indicator. So we're giving a free trial until the 15th, or if you've seen enough, just come in and buy the indicator. Here's the whichever one you like. Here's the address. Okay, and the advantage of one version over the other is that the Kase StatWare gives you much more to interpret. So if you're the kind of trader that really likes to interpret indicator patterns and exactly how the indicator looks, you might be happier with the first system. If what you want is just for it to tell you that it's divergent, you don't want to look at exactly what the shape of the divergence is and stuff like that. You want to clear your mind and look at the pattern on the chart and have the arrows and diamonds as a guide. That's maybe for you. Of course, I would think that everybody should buy both, but it just depends on how much you like to interpret indicator patterns versus price patterns. Okay, so the non-discounted, the regular rate, non-discount is $195 a month. So that's the non-discounted rate. So with that, I think I have one more slide I have to show you, which is my standard disclaimer, so we don't get in trouble, but I'm going to put it back on here and just open it up for, let's say, 5 minutes worth of questions, and then we'll call it a wrap. Dean, I'll let you articulate the questions to me that you think we should be answering.
Okay, so well, just to clarify real quick, it's $18.95 for a 13-month subscription. So it's not $18.95 per month.
Right.
$18.95 for the 13-month subscription.
Yeah, the actual cost is about little less than $150 a month versus our normal price of $195. I think it's $147 versus $195.
Right, and so this is the special that we're going to be running until May 16th, and the trial during that period of time will run out until May 15th. Just to clarify that point.
Yeah, and it's a 13-month pay up front. After that, you can go to month if you like. Any other questions?
So Cynthia, we had lots of questions. The primary questions that we had were about time frame, bar length, using the indicators on shorter bar lengths like 5-minute or 3-minute or different types of bars, range bars, Renko bars.
Yeah, I mean,
so you might want.
Yeah, I mean, I haven't personally used time bars for less than daily for 30 years. I've always, even before there were range bars, I used tick volume bars. So to me, a bar is a bar. The only thing that you have to watch out for, again, is you can't trade a time frame that's too short to have any price information in it. So if the close of one bar, if the high-low close of each bar, if the highs and lows of bars line up with one another, and the only difference is that the open of one bar is the close of another bar, you're probably trading too short a bar. But this isn't a function of Kase StatWare or Kase Private Label. If you're trading too short a bar, you're trading too short a bar no matter what you're trading. So as long as you're trading a bar that's long enough to trade with, this stuff works. The other piece of it is that I alluded to earlier is if you're trading range bars, we have different setting recommendations. Now, on the Kase Private Label, the settings will change automatically. You don't have to do anything. The system will read whether or not you're trading a range type bar or a time type bar, and it will adjust the stops automatically. We're Kase StatWare, we have settings for the stops, and you have to adjust those manually. Is that right, Dean?
I'm sorry, Cynthia, say that again?
There's no automatic adjustment on the tick versus the time versus on StatWare.
Range?
Yeah.
On StatWare, it automatically adjusts the depth stops there as well.
Yeah.
It does automatically adjust those.
And you know, if you don't have the $18.95 up front, you could do one of two things. Just take a regular standard subscription of Kase StatWare, and we'd give you the bonus after the 13 months. Just take a regular normal subscription, $195 a month. You have to pay 3 months up front. You could always put it on your credit card. So those are the two things you could do if you don't have the $18.95 up front. The chat room will be 7:30 Pacific, 10:30 New York time every morning except weekends from tomorrow through the 16th. And the trial is just a download. You download the trial, put it on your chart, and you're good to go. Okay. The chat room will be mostly educational. If somebody has the chat room will be mostly educational. If you have a particular question about a particular chart, we'll be glad to tell you what we would recommend a signal would be. Now, I am a commodity trading advisor. I cannot advise you about buying or selling anything other than futures contracts and things of that genre. Physical and futures. I can't make recommendations on the stock market, but I can certainly interpret the signals for you. Any other questions?
Yeah, so what I was going to
Go ahead, Dean.
say here, Cynthia,
Yeah.
is we should clarify that we do not have a trade room. This is not a trade room. We're not going to be calling out trades, just like Cynthia just alluded to, but we will use it for educational purposes to show various charts, various time frames, various bar types, using both Kase StatWare and Kase Private Label to show you how to best use them, different techniques that we have developed over the years, or styles that we've seen from various types of traders.
Okay, let me conclude by saying this. And this is the same approach I've had with the corporate and institutional traders that I've been working with for more than 35 years. I want you to learn how to trade. My goal is not to sit and say, buy here, sell here, buy here, sell here. My approach is to give you the tools, the best tools out there for trading, so that you can learn to use your brain along with these best tools to learn how to trade. When you learn how to trade on your own, rather than somebody telling you buy, sell, that's what will really make you a successful trader for the long run. Thanks everybody for having joined me. I hope to see you in the chat room tomorrow, and please download a no-charge trial of both of the indicators. You'll be happy you did. Good night.
All right, I'd like to give a very special thank you to Cynthia Kase of Kase StatWare for providing the NinjaTrader family here with a great discount on their trading products. So today is your chance to make those confidence trades just as Cynthia does. So definitely take the next step. Sign up for the free trial and take advantage of the huge discount offered by Cynthia here today. One more time, I'll post this link in the room here so you can navigate to that the recording of the presentation and the free trial link and the ability to purchase and take advantage of that discount. Once more, I'd like to give a very special thank you to Cynthia for a great presentation. Happy trading from all of us here at NinjaTrader. Thanks, everyone.